Good afternoon, everyone, and welcome to today's webinar. Today is Wednesday, August 7th, and today's webinar is Home Loans, Traditional VAs, Native American Direct Loan, Section 184 in USDA Rural Development Opportunities. Your instructor today is Marie Bonville. My name is Alyssa Atkins, and today I will be your webinar facilitator. I am the Training and Development Coordinator for the Native Learning Center. Just a quick disclaimer before we get started. This disclaimer provides a summary of fundamental concepts, requirements, and/or procedures within the allotted 90 minutes. The material discussed does not illustrate all possible scenarios that could be applicable. Also displayed here is our copyright infringement law. This is just a friendly reminder that the webinar presentation materials are protected by copyright, trademark, trade secret, and other intellectual property laws. Before we get started, I want to familiarize you with some of the features available to interact with today's webinar. If you look at the top of your screen, you will see an icon of a hand with a plus sign. By clicking that icon, you can either raise hand, agree, disagree, applaud, or step away. Now your screen should look similar to the graphic here. To the bottom left, you will see a pod that says Files. Here you will find any handouts or appendix items included in today's presentation. Please feel free to download a copy for yourself. Just hover over the item you want to download with your mouse, then click the arrow pointing downwards to download and save onto your device. Once the item is downloaded, it should appear in your device's download section. The second pod to the right, labeled Web Links, is where you will find our survey about today's webinar, along with the link to receive our weekly newsletter. Connect with the Native Learning Center on LinkedIn and any other links that will be seen throughout today's presentation. Finally, to the right of the screen, we have a chat pod available. This is how you will communicate with the instructor and NLC staff. If you have any questions during the presentation, we welcome you to send them in by using the chat box. Simply type your message into the space that says type here and hit enter or click that up arrow icon button to submit. We do encourage class participation, so please feel free to write in those questions or comments. Tech support issues should also be submitted here. Know that most can be solved by leaving and rejoining the meeting room. Let's all get the chat box going together now by typing in your name, where you're joining us from, your tribal affiliation, and your work or role in Indian country. It is now with a pleasure that I introduce Marie Bonville.
Well, thank you, Alyssa. I appreciate the warm welcome. And thank you, everybody in the room. I see some familiar faces, not faces, but names, I guess. I see your faces when I look at your names, right? So we'll go ahead and get started. But thank you again for taking your time to be here today. A little bit about myself. I started my career with the Seminole Tribe of Florida back in 2007. I've held a couple different positions. As the Director of Training and Technical Assistance for the Native Learning Center, of course, is where I met most of you, and also was introduced to housing and homeownership education, working very closely with the tribal housing authorities and TDHEs. Certainly, having branched off from that and working with my husband to start a small business, as he's a general contractor, and I run the real estate side of that as a realty group. You know, there's a whole nother host of information that assisted me in learning more about the homeownership process from a larger market perspective. And so that's brought a lot to what we train on and what I bring to the conversation. And then this is hot off the presses, folks. I am going to accept a position with as a program officer for OWISTA, which is a Native CDFI intermediary based out of Denver, Colorado. So I will be starting that position soon. And so certainly the Native CDFI space is growing homeownership education. They've always been in the Native education, homeownership education space, but in terms of Native CDFIs being much more supportive and helpful for our borrowers, this is going to be a great new space that I will be a part of. So I'm excited for that. So a little bit about today. Most of you know why you're here. We're going to talk about the home buying process, and we're specifically going to hone in on how it relates to the home loan itself. Banks are businesses and businesses sell products. And so when you look at a product, typically when you're thinking about purchasing, and it doesn't matter what it is really, whether it's a car or a new phone, you evaluate those apples to apples, right? You determine what's the best value for you. And so a lot of times when you meet with the lender, there's some evaluation going on as to which program would benefit you the best depending on its design, right? So that's where, and it's a mouthful, Section 184 USDA 502, conventional loans, VA loans, Native American direct loans, how do they all fit? And what does it look like for you? What would be the best option? Well, the more you know, the better informed of a decision you can make. So that's kind of why we're here. I'm also going to give you, again, going back to the real estate side of the equation, I think it's really important that we navigate this process and take out the stress of home buying. It is a very individual um, uh, process in that for every family it'll look a little different, right? Their finances are built differently. The home loan they choose will be different, and so you're kind of driving the same vehicle, but you're going to different places and spaces. It's different routes, right? So it's really important that we know who the key figures are, whether it's the loan officer, the appraiser. What's the difference between an appraiser and an inspector, right? Who's the underwriter and what do they do? It's really important to know that terminology. It'll make your buyers much more comfortable. If you're using this presentation as a buyer, that's great. If you're choosing as a practitioner to take some of these slides and use them for your own homeownership education training, that's great as well. So the slides are really built for you to be able to pull things out and use them as you see fit. But then also exploring some of the loan comparisons, the differences between the loans, and of course, navigating closing. The worst thing that could happen is you prepare a home buyer for the process, or you yourself are almost there, and you get to closing and there's a pitfall, right? There's someone that does something, either they purchase something on a credit card, or they make a mistake and leave a job, right? Or do something prior to the home loan closing. We don't want those sorts of things to happen. So we'll talk a little bit about that as well. So what you might have missed, going back to the home buying process and looking at it from the market perspective, is that some things have changed, some things have stayed the same since the last time I did this training. So thought it might be good to talk about that. June was National Home Ownership Month. And there really is a commitment to housing counseling that I want to share with you, in that, housing counseling, that is expanding, right? The world of housing counseling, especially for Native communities, is expanding. I know there's some confirmation that now, if you're ICDBG or IHBG funded for some of your down payment assistance programs and things like that, you will need to be HUD housing counseling certified or have somebody on staff provide that for your clients. So knowing that, what does it mean? It means expanding home ownership, right? And that's definitely with your first time home buyers, your low AMI. By AMI, I mean moderate income or affordable area medium income. So your low, moderately low income communities and communities of color. So there's also collaborative design, meaning each reservation I go to, each community that I'm serving, we're going to look at the design of what it takes to own a home on your tribal trust lands, or maybe it's allotted lands, or maybe it's an urban area. So what does that look like for your community, right? And then assistance and support. There's going to be a lot more training in terms of getting housing counseling certified. That's going to be out there for you all to participate in. And then lastly, expanding education to include alternatives to the standard products. There's new Native centric homeownership opportunities through Home One. We'll talk about that a little bit. And then also like I said before, the Native CDFIs are really reaching into the space and providing education and training as well. So home loan basics, we're going to jump right into it. And I will check the chat area. Wista, I know, is going to be checking as well. But to just start off with a little bit of fun, I think most of us are familiar with the game here of Monopoly. And so go ahead and put it in the chat area. What's the purpose of Monopoly, right? What's the main goal when you play this game? And be nice. I know some folks get pretty ruthless when it comes to monopoly, but someone give me the general definition of how monopoly works. Let's look for it in the chat. Shelly's typing. Let's see who gets there first. Let's see. To own as much property as possible, right? So that is the goal of monopoly. The more you own, the more likely you are to then start to collect rent and become the player with the most money at the end of the game, right? And so, of course, when you're playing the game of Monopoly, um, you realize quickly that it can be pretty competitive, that it's an emotional game, right? Folks can really be aggressive about when you land on their property, right? Collecting their rent. So I think that with everything, times change, and so with Monopoly, they also had to kind of update their circumstance and situation. But I think when you move too fast, too quickly, right, when things get hot and heavy, that bad things can happen. And so even Monopoly realized that that things have changed in many ways. And so I thought it funny that they even have a cheaters edition. I think most people just thought the game was too long. But in regards to 2008, why I bring it up is because a lot of what you'll see today is as a result of the need for basic homeownership education. In 2008, we had the Great Recession, and much of that recession had to do with the housing market and the homeowners not really understanding what they signed up for, right? Whether that was an adjustable mortgage rate or maybe signing for a loan that didn't have the security, the backing necessary to be supported, right? So there's a lot of people sometimes get frustrated with the homeownership process because they're not understanding, well, who makes these rules, right? Where do they come from? And of course, the GSEs, the government sponsored enterprises, have their a public purpose, but private ownership, right? So sometimes you'll see that in the case of a loan limit, right? Somebody might say, well, how come I can't get a loan for X amount of dollars? It could be that they're not allowed to do that. And so that's when you hear the word conforming, that's what that means, is that the loans that we're going to talk about today, they're all conforming loans. In order for Fannie Mae or Freddie Mac, those folks on the secondary mortgage market, for them to sell these loans, they need to make sure it's conforming. And those standards are set by the Federal Housing Finance Agency, the FHFA, right? So I just wanted to put that out there because a lot of people don't see the connection of how one thing leads to another. Non-conforming loans, those are the kind of things we steer our clients away from anyway, right? Whether it's loan amount or it's adjustable mortgage rates or it's interest only, balloon payments, things like that. Those are all considered non-conforming loans, and that's not what we're going to talk about today. But as far as millennials go and the future of homeownership, where do we go from here? What does it look like, right? I think it's important to note that it's not what you see on TV, right? Most of the time in Native communities, there's not a whole lot of existing homes for sale, although there may be one or two. For the most part, we're talking new construction, whether that's manufactured, modular, or stick built. And those homes have a process that they have to go through. If they're on tribal trust, it's different from allotted lands, but it could also be that you're purchasing off reservation, right? So it doesn't look like what most of our buyers are familiar with when they go to HGTV or when they watch things. They get information from all over the place these days, mostly TikTok, if I'm honest. Quick little sound bites of how the process works, and it may not be accurate. So this is what people think home buying looks like, right? That linear look at houses, make an offer, close. And what it actually looks like is much more um, cyclical. It's flowing. It has other things that may happen that could deter them from being in the process. So we've got to keep hopes up. We got to be positive. We have to assist them and support them in understanding all the things that can maybe derail the process of buying a home. So what could those things be, right? Well, as this picture shows pretty clearly, that it can be hard to find affordable housing, especially in Native communities. Affordable housing has always been a concern, an issue for us in areas where their economy isn't as strong. But certainly, when the larger economy with the big E, when the large economy is fluctuating, right? Interest rates are changing and rising. That's going to also affect affordability, right? So, how do we combat that? Um, well, there are a couple ways, and I'll explain those here in a little bit. What I did want to mention is that interest rates and inflation. So, of course, after 2020, there was pretty much a boom in the market in terms of home ownership prices. The home prices have risen. I think the median household in America it's roughly 400,000, a little under 400,000. That's a lot, right? So inflation and interest rates are connected. They actually are connected, and I'll show you how. But here you can see that 22% of Americans said that they now owe between 10,000 and 20,000 in credit card debt, and 5% have more than $30,000 in debt. The Federal Reserve has raised interest rates 11 times since 2022 to lower sky high inflation. So after the pandemic, right? During the pandemic, folks were able to save. And now after the pandemic, we're seeing that folks are moving back towards utilizing their credit cards and relying on debt. And of course, affordability, cost of living is increased. We understand why. It's important to know that the Federal Reserve Board is moving interest rates even now. It's my understanding that it's going down. That there's some stability there with inflation, but here you can see the direct correlation between the current housing prices, 2020, of course, and then it spike when interest rates went down to as little as 3% to 2.8%. So the market has a huge effect on what our borrowers experience. Some folks say, I'm going to wait. I'm going to wait to buy a house because I want interest rates to go back down. And so this is a really great graph because it really does show, well, what's the highest it's ever been? So for those folks who always ask that question, I circled it. In 1982, it was 81, it was 16.63 was the average interest rate. So that's really high, right? But as you can see with the rest of the years, we teeter anywhere between 5 and 6%. If you average it out. Between the time of the Great Recession, which was 2008, it was at the height, it was 6%, right? And it steadily declined, right? Interest rates went down. And that was because we had to try to have a market that was recovering, right, from the fallout. And so interest rates stayed between 3 and 4 for mostly, what's that look like? Almost 6 or 7 years, right? And then even longer than that, maybe 8 or 9 years, right? And then, of course, in 2020, it dipped into uh, 2.96, so below 3. And that's because we didn't know what was happening with the market. Of course, jobs, people's health, of course, first and foremost, being top of mind and priority. Essential workers, really being the only ones allowed in the market to work. So those are the sorts of things that people have, on their mind. Is like, what are interest rates? How's that going to affect my payment? In 2024, till January, the interest rates were at 6.84%. As of Monday last week, it was that was last week, 6.375. So we do see it going down. It's my understanding again that it might go down again by September. So, what are people worried about? Inflation, right? Higher interest rates, lack of inventory, not enough housing. Certainly, there's been a real push to build. But then what does that do to building costs? And then, how much will that increase the home prices as well? and other housing costs increases, right? Where there's a lack of qualified professionals that do the hard work of building a home, right? Plumbers, electrical workers, etc., electricians. So just think about those sorts of things when you're thinking about home ownership. These are when I put in Google Trends, this is the kind of stuff that comes up when it comes to home ownership. So let's unpack the loan actors and key terms. This is going to be essential for your clients. Of course, your housing counselor, your loan officers, your processors, your underwriters. We'll talk a little bit about what they do. Your inspectors, appraisers, insurance agents, and depending on the state you live in, you might have a title company or an attorney that handles your real estate transactions. Just kind of depends. Some folks are fortunate enough to have land management offices that handle them, or realty offices that handle them within your tribe, which is a great resource as well. But the buyer essentials, the things that most folks need to know is their down payment. What will that look like? Most buyers are familiar with down payment, so that's an easy one. But they kind of don't understand that closing costs is a separate cost to home ownership, right? So we want to break those two out and make sure they understand the definition separately. Debt to income, right? What is the relationship between your debt, how much debt you have monthly, and how much income you make monthly? And then of course home types. Going back to selection, depending on where you live in the country, a stick-built home may cost much more than maybe manufactured, but you also have to look at transportation costs to move the home to the site, etc. Inspections, appraisals, all those costs also vary. Here in the Southeast, most inspections are running, well, of course, it depends on the size of the home, but anywhere between $300 and $600, I would say. Whereas I know in South Dakota, that number is closer to 800 or more, depending because of the drive time for those inspectors or appraisers. So it just kind of depends on the location. I'm going to double check the chat. Yes, there will be a copy of the presentation. And I also have a lot of resources that I have downloaded that I want you all to be aware of where they're located. So I'm going to show you them, even though they're in the files area. As I talk about them, I'll slide them out and show you what I'm actually looking at, so that you can also have it as well. Mortgage terms and conditions, right? What's an assumable mortgage, right? How does that work? How could that benefit you in these times? Certainly, if your interest rate, if you have a family member who's wanting to sell their home to you, you might want to see if their loan is assumable. That essentially just means that um, the home loan that they have can be purchased by the new person, and that person can retain that interest rate, which is a great savings, right? So some parents do that for children. You can take over my mortgage essentially, and you'll have a lower interest rate. That's a good thing. But there are caveats. Not every loan program has that option of an assumable mortgage. So we'll talk about that a little bit as well. And of course, home affordability. We want to make sure you can afford the home. So we'll talk about payment shock and some of the other things that home loans that come with, wanting to um, purchase a home. So the first thing is the loan officer. Their job is to assess the buyer's strengths and weaknesses. They're the first line of defense for the lender, and this lender can be private, so Bank of America, Wells Fargo, your banks, could be a credit union, um, or it could be a native CDFI if they have their own home loan product. It could be that you're getting a loan that's backed by the federal government. What do I mean backed by the federal government? There's a loan guarantee process that they've gone through to allow for this loan to take place. And we'll talk much more about that here in a minute. But typically you'll hear FHA, USDA, Section 184. What does it all mean? So the lender really should have an idea of these programs. The one you're going to work with specifically in your community should be very intimate with the programs such as Section 184 and NADL, right? Because they're serving Indian country. And so if they don't, that could be cause for concern, right? So what I would like to tell folks is although I appreciate new learners, I don't want to be your learning curve. If you're new to the industry, I'm sure there's a buyer for you, but I want somebody who understands Indian country, who understands the loan products, who understands the down payment assistance products, because it's going, or excuse me, the down payment assistance programs, because it's going to assist you all as the housing facilitators, whether you're a housing counselor, or your intake, or maybe you're just assisting with folks in your community. No matter the role, you want to see success. And it can be really hard if that person doesn't have an understanding of how your programs operate, right? So, with that, these are the questions you ask your loan officer. How long have you been in the industry? Are you familiar with the down payment assistance programs in my community, with my tribe? If not, maybe with the city or the county. I have a group out of California. I don't know if he's on the call today, Dave Cade. He is out of, let's see, Santa Rosa, let me get this right. Santa Rosa County, Dry Creek Rancheria, Band of Pomo Indians. So Dave is in a tough spot, right? Because as executive director of his housing authority, the median income, I think, is not, excuse me, the median home in that area is $900,000. It's very, very pricey. It's in Sonoma County. That's where it is, Sonoma County. And the problem with that is that the down payment assistance that the tribe provides is still not enough to assist the home buyers. So Dave actually received a grant from the state of California to also provide down payment assistance, and it's a considerable amount. And so, when when you don't work with a lender who gets it, you're going to end up leaving money on the table. That's how this works, right? Because they may not know how to handle all the different down payment assistance programs that you're between your tribe, your city, your county, right? And in Dave's case, he's actually working with all the different groups, both the counties, the state, and the tribe, to assist the homeowner, right? So that's great, but I do feel like, again, you don't want to be anybody's learning curve. So here it breaks it down even more in terms of loan officer versus loan processor, and then the underwriter. The loan processor, is typically the person you meet via email, because they're going to be asking that you submit certain documentation if you already haven't submitted it to the loan officer. And they'll make sure all the paperwork is in the right order. They might have follow-up questions regarding the paperwork, or determine that, maybe a follow-up meeting or phone call is necessary to clarify. And it gives you that, second set of guidance from the loan officer. But I will say, the loan officer is where you get like a relationship. Typically, this person hopefully will be your loan officer for life. And so they know exactly how this thing happened to your credit, or, they know about your familial situation. They know about why you need a bigger home. They get more of the personal part of the home loan process. You're going to give them a lot of information, but that's really separate from once you go down the line to the underwriter. This person, the underwriter, he or she, or in many cases, it's an automated system, is only evaluating, does this loan meet the standards as required by the GSEs? Do they have everything, the DTI, is everything lined up correctly? And so they don't have the warm and fuzzy. And that's not the case of all home loans. We'll talk about Section 184, for example, that has a manual underwriter. But know that the underwriter's role is to protect the bank and the risk that they're taking in lending the amount you're asking for. So, and I took this directly from a lender's Facebook page, because I wanted you to kind of get an inside look at what they're thinking, right? So it says here, when your borrower submits all the documents all at once. It's rare, but it does happen. they're going to ask you for a lot of documentation. It's imperative that you turn it in on time and as quickly as possible to keep this process moving forward smoothly. So pay stubs for the last 30 days, W-2, they'll ask for those forms for the last 2 years. Well, if you're not the type of person that keeps up with these things, then you might want to go ahead and get that settled before you start the process, right? Sign federal tax forms for the last two returns for the last 2 years. That's also essential. Sometimes, let's say you filed an extension. Sometimes they can go ahead and get the last 2 years, and the documentation that there's an extension on file can sometimes be the case depending on the loan product. Documentation of any other sources of income. This can be a big one because we do have some, entrepreneurs among us, and so it can be, if you're not documenting the source of income, you may or may not be able to use it, especially if it wasn't claimed on your income tax. That can be something that the loan officer is going to flag. Your bank statements, you're going to need your two most recent. And I have a little side note, be careful with Zelle, Cash App, PayPal, those sorts of deposits, anything over $500, they will want to know more about that deposit into your account. So I think when you're going through the home buying process, it's really important to kind of make sure you're being mindful of your transactions, because through the bank statements, they are going to ask certain questions. Down payment, as far as the source of the down payment. So large down payments, large deposits are going to also be flagged. There's this thing called source and seasoned. It's a term in which they're just saying, look, we want to know where it came from, and when we want to know how long it's been there. And it's not forever and ever. It's just 2 months worth. They typically they want to see that you've had the money in the account for 2 months, and then they won't question it. Any shorter than that, right? So if you realized you don't have enough for your down payment, and you go and take the money off out of the back under the mattress, and you put it in a deposit, that's going to flag, because they're going to say, well, where did the money come from? So just think about that. Make sure you have your proof of identity. Of course, your tribal ID is sufficient. And in the case of Section 184 and ADL, you're going to need that documentation as well. You're going to need, of course, your certificate of housing counseling. If you're going through the home buying process and getting some sort of down payment assistance, they're going to need that as well. We'll talk a little bit about credit, not a whole lot, but know that they are going to pull from a tri-merge or some sort of credit from these 3 credit bureaus. Why I bring up the fact that they're regional is that sometimes it could be that they're not, whatever your credit report is showing, you may not see it on all 3 credit bureaus. So that's something to note. And that's something that it's an easy fix. You can always just go ahead and look that up in terms of whether or not it's showing on all 3 credit bureaus, and if not, why. The question in the chat says, does the source and season include 401k distribution as well? And the answer is it does, but it's allowed. So you are allowed to take monies from your 401k. Sometimes just a letter of explanation is enough to allow, but 401k, as far as I know, it is allowed in most of the products we're going to talk about today, if not all of them. And then certainly with the loan officer, you can confirm how they'd like to see that, whether it's simply just a statement from your 401k, or whether or not they want a letter of explanation as well. But that's a really good question. Financial institutions are businesses. Businesses sell products. Credit cards, personal loans, car loans, they're all products. And if you think about it like that, you'll be able to make a better decision financially when you decide to use them, right? I think some folks, going back to that Monopoly game with the credit card, when you use a credit card, you don't always feel it. And so if you start to think about their products as the things that you use from banks as products, you'll be more mindful of that. Types of credit they're looking at are installment, revolving, and open credit. And so your score itself is just a financial picture. It's taking a snapshot and saying, this is what Samuel's credit looks like today, right? In most cases, every couple months, they're going to go ahead and do that if your loan process is taking longer than 45 to 60 days. They may pull your credit multiple times during the process. So be mindful of that. Your score consists of a couple things. How you pay your bills, that's 35%. Your history, right? Are you on time? 30, 60, 90 days late. All that information is on there. The amount of money you owe, right? So your utility, like how often are you using this card and how much do you owe? So if I have a $1,000 credit card and I use $500, well, I'm at 50% utility. I've used 50% of that card, right? Maybe if I'm at 99%, the bank may think that I may not be financially sound because I'm really close to the edge there. So when you start thinking like they would think, it helps. Length of credit history, that's simply saying how long have I had the account open. Sometimes hurts people because folks don't realize that. And, when they have negative experiences with credit, they may say, you know what, I'm just going to close the account. That may do more harm than good, right? So it's a little counterintuitive. I know it feels good to say I'm going to close the account, but it may actually hurt your credit. And then a mix of credit. They like to see, going back to what I said before about installment, revolving, and open credit. Installment credit, things like a car loan, right? You're paying it in installments, and eventually it'll get zeroed out. Whereas revolving credit is like a credit card, where you can use that card over and over again, pay the balance off, and then it's available. The credit is available for use. And new credit applications is 10%. So some folks don't see that as a whole lot, but when you think about it, and I tell this story, it was one back to school, so probably like September, August. My mom went to the store and she was like, well, I don't have any money for back to school shopping. We're just going to get a credit card. So she went to the first place and she got approved. She went to the second place and she got approved. She went to the third place and the fun stopped there, folks. Right. Because, they were realizing like, okay, well, this person's applying for a lot of new credit pretty quickly. What's that about? So that it just, be mindful of the fact that new credit applications can also hurt you if it's not in a very specific time period or snapshot of time. Sometimes it can hurt you. There are some exceptions, and that is a car loan and a home loan. There's a window there where you're allowed to go ahead and shop, for the best deal. But when it comes to credit cards, they don't like to see several applications at a time. So this is typically the range, 620 or below, poor credit, 620 to 690, fair credit, 691 to 620, 720, good credit, 720 to 750, good to excellent, 751 and above, excellent credit. So that kind of breaks down the standard view of it. When you're looking at purchasing a home, this is kind of like behind the scenes. The loan officer has some rules that they have to follow depending on the home loan that you choose. So the first one is housing expense ratio, or front end ratio. Some folks call it that. And the idea is, what is the relationship between your gross monthly income and your housing expenses, right? So housing expenses are your principal, your interest, your taxes, and your insurance. That's going to be what makes your house payment, essentially. So there's a relationship there, and they want to see what it is. To do that, of course, they check your income, and this is what it looks like. So client A has a total gross monthly income of $6,800. They have selected a loan product where it's 29%. And that's the maximum that this person can have in ratio. And when they do the math, at 29%, they're looking at $1,972. So that's the maximum amount this particular person of a home loan principal, interest, taxes, and insurance. That's as much as they can get, right? So some folks always ask, where do they come up with these numbers? Where do they come from? So the housing ratio is one element to this that your loan officer is going to look into. And the other one is debt to income. And this one's, I think, certainly more popular in terms of folks being aware that it's a ratio that's important to them. And you'll see that with many of the loans, depending on what that maximum amount is for the debt to income ratio, it's the difference between being able to purchase a home or not. So it's that relationship between your debt and your income. It's a good financial picture. So sometimes people look at it like that, like depending on where you are with your debt to income ratio, well, that shows you're, you know, doing really well in terms of credit. Um, so let's look at it. And if you're a visual learner, which I am, then this really just breaks it down. So it's your debt, right? Things that you spend and pay monthly versus your monthly income. So debt divided by income. And that's all it is. Some of the biggest questions I get about debt to income have to do with what type of debt. It's anything that's being reported on your credit report. That is what they're looking at. So you won't typically see insurance payments on there. You won't see T-Mobile or any sort of, phone payments, utilities, things like that. It's basically things that are being reported on your credit that they're reviewing. But in the case of some of the products, as I said before, in this case, this person, the DTI, he made 2,400 a month, and his debt was 700. So 700 divided by 2,400, he had a DTI of 29%, right? So that's pretty low. It's really low, actually. Some of the programs we're going to talk about, you can have a DTI of 41%. So just know that if you can start lowering your debts now before you start the home loan process, the better off you'll be. Just a quick note: wages, salaries, tips, pensions, Social Security, child support, VA benefits, and other additional income like 401k deposits are allowed. But as far as income goes, it can be included. And then what's not included in DTI ratio is your monthly utilities, car insurance, phones, as I said before, groceries, things of that nature. So here's another one where they've selected, let's say, Section 184, which is 41%. And here you can see here, they make $6,500 a month. When you do the math, they're making more, but they're also spending more, right? You can see here that is the debt to income amount based on the maximum amount of house payment they could afford. So the loan officers are doing the work of making sure that you qualify. Some folks get confused: pre-qualification versus pre-approval. Why does it matter? When you're looking at a home, especially if the home is on the market, so an existing home, most sellers would love to see a pre-approval instead of a pre-qualification. And a pre-qualification doesn't take a whole lot. It's an estimate of your income, an estimate of your assets. They'll do what's called a soft pull on your credit. And they haven't actually verified your employment yet. They haven't talked to your employer. So it's a little like you're interested, but you haven't turned in all the paperwork, right? But based on what we see and what we know about what you've provided information-wise, we can give you a pre-qual. The pre-approval is a little different in that they're verifying everything. It's actually going through a process of being verified to the point where it has everything necessary to go through underwriting. In some cases, it's already underwritten. And so the pre-approval is a very, very helpful tool. If let's say you're in an urban area where you're fighting with other folks in the market, it's really great when you can provide a pre-approval for your with your offer as opposed to a pre-qual. The loan estimate. This is born directly out of 2008. Folks didn't understand what they were looking at. How much am I asking for in a loan? What is the interest rate? What's my monthly payment going to be? So, formerly called the good faith estimate, the loan estimate is definitely a great tool, and I have the link for you in the presentation. But the loan estimate helps with breaking down the essentials. So now we're going to switch gears and talk about the home loan that you select, because this is going to be really important moving forward. We'll start with conventional. Then we'll move into, actually, I think this is out of order. We're going to start with conventional, and then we'll talk about FHA, Section 184, NADL, VA, and then lastly, but not least, USDA 502. So the cost of buying a home is something that folks aren't always familiar with. So we always ask that they start thinking about budgeting first. Save as much as you can because there are some costs that are associated with purchasing a home. Things like application fees, inspection fees, loan origination fees, or funding fees, as they're called, credit report fees, appraisal fees, title search and insurance fees, and any other costs agreed to by the seller or buyer, right? So there are a lot of things that folks need to consider that are outside of that down payment. One in which is the inspection. Typically, you're paying the inspection prior to closing, so it's not like you have to have that money up front, right? And they are evaluating the physical condition of the home. So here you can kind of see there's some threshold damage, and so it notes that, right? That's what an inspection report does. It allows you as the buyer to say, okay, are there some issues with the home? They want the list price is $360. Maybe I can offer $345 because there's some things that need fixing, right? So there's a difference between your list price, right? What it's listed for versus offer price, what you offer as the buyer, and then what it appraises for is based on whatever the bank appraiser evaluates and says. What do I mean by that? An appraiser's job is to evaluate the home based on a couple different things. So a bank will never lend you more than a home is worth. That's just the truth of the matter. So if that's the case, then the bank has to send someone out. So the home appraiser works for the bank, and their job is to say apples to apples. If everyone's house on the block is selling for $345, why should we lend you $370 for this home? What about this home makes it any different, right? So they're doing some evaluation. And hopefully, if you're using an agent and this is like a market that has agents, then that agent will assist you in, making sure your offer is reasonable and competitive. But, the appraiser's job is to basically compare the homes in the area. Typically, it's usually a mile out, but in rural areas, it could be, further than that. And they can do what's called a sales comparison. They can also make adjustments, right? They can say, well, this house has 3 bedrooms, 2 baths, but the house you're wanting has 4 bedrooms and 5 baths, right? You're probably not that many baths. But my point is they can make adjustments and they can evaluate it based on what they're seeing in the home. And also the area that it's located can also have an impact on that home appraisal. So that's just how appraisals work. In some of the areas I work in, right? So in South Dakota, for example, Cheyenne River Housing Authority, they have a community that they've developed that already has sewer, water, electrical hookups, all of the things that can sometimes be a cost to their borrower. So in this particular case, when an appraiser goes out there, they're going to do the cost income approach because they don't have as many comparisons. They may only sell 1 or 2 a year, and so in that case, they're going to basically look at the construction of the home when the modular is built, and then they'll make an appraisal based on that. Does that make sense? Again, any questions, feel free to put it in the chat. So here's basically what an appraisal report looks like. As I said before, it's going to be apples to apples, right? So you've got a subject property, then you got 3 homes to compare it to. Some will be the same, some will be maybe a little different. But the whole point is for that appraiser to get close to hopefully the number that you all offered. And sometimes appraisals come in short. And when that happens, you can have a delay. So especially in the case of buying new construction, it's important to know that you have to stick with being smart about the appraisal process, right? If you're in the manufacturer's show house and they've got all these upgrades and you're like, yes to everything, I want the works, know that the home may not appraise, right? So you want to be careful or mindful of that. So let's talk about underwriting. Again, the underwriter reviews the application. Everybody remembers the Wizard of Oz, the man behind the curtain, right? That's what the underwriter does. They have no formal connection to the buyer. They don't know the personal stories and all of the things that I said you would tell the loan officer. Their job is to evaluate risk. And I say they, but it's really an automated system now. And so your conventional loans, for example, for sure, your VA loan will be automated in that regard. Okay, so you've been approved. You've gotten your clear to close. Where do we go from here, right? Well, this is what it looks like. You might still have some conditions to closing if, let's say, they evaluate your income taxes and you owe some money, right? Because that's not reported. That debt is not reported um, on your um, on your credit. So there could be a condition that requires you to show those payments that you're making. It could be maybe rent based, right? You don't have a whole lot of credit for them to evaluate. They may say, "Can we get 12 months worth of your rent checks?" Right, to confirm that you've been making those payments on time. So sometimes conditions happen. I think we just if you remind folks that that could happen, then it's not as bad. It doesn't feel as bad to the clients that you're serving. I think when you don't let them know what an underwriter's job is, then when these conditions happen, folks get frustrated or say, "I'm not sending you another thing," right? We don't want that. So just think about that and put yourself in their shoes. It can be frustrating. You're so close to the end of the process. Um, but when you are clear to close, you'll get what's called a closing disclosure. Again, the link is there and you'll be able to look this up. But essentially, this is the document that breaks down every cost to the borrower. And so it's really important that they know how to read this form. It's very easy to follow along. Closing disclosures are pretty easy. So I'll move on from there. Let's see here. So we had a clear to close, and you went and applied for a Kohl's card to save 20% on a $50 purchase, right? What does that mean? As I said before, there's some things you got to watch out for. Getting new credit cards is one of those things. I like to tell my clients it's like taking a financial picture. Think of a camera, think of a snapshot. When they took your financial picture, it can always get better, right? Maybe it was dark and cloudy and now the sun is shining, right? The picture can always get better. It can't get worse, meaning you can't open new credit cards. You can't apply for new credit. You can't have any late payments that might hurt you. Shopping for new furniture. I know you're excited about a home, but avoid new furniture, car purchases. Some folks will say, "Oh, well, my car broke down, so I had to buy a new car." Just they've got to be real careful about their credit at this particular time because they've already taken that snapshot. So your credit and your credit score can always improve, but it can't get worse, right? Irregular deposits and withdrawals from funding accounts, right? So, if you're selling your cousin back and forth, even if you think you're doing a good thing, it could come back to hurt you, right? So, use me as the bad guy and tell folks, "Sorry, I can't lend you money right now," or "Sorry, um, you know, I can't use Cash App or Zelle." It's just that it's really hard to follow those trails and know what those transactions are about. I recently had a client that was having their ex-husband send payments for their child, school, back to school shopping or whatever. And she didn't think anything of it. He was just reimbursing her. But the bank wanted to know, what were these deposits for? Is that considered child support? Like, it went into like a whole nother line of questioning that she didn't anticipate. So I would just say be mindful of that. And then of course, avoid quitting your job. I know some folks say, soon as I get this house, I'm done with this place. And that might be true, but they can verify employment up to the day of closing. And it has happened where folks, if the employer says they're no longer employed with them, that is definitely going to affect your ability to close. So just be careful with that. And of course, a closing itself is just meaning that you're settling the documents, the legal ownership of the home is going to get transferred. And so that's that. So sometimes at the table, you could have the buyer, the seller, your agents, your real estate agents if you're in an urban area, your lenders, your housing counselors for certain will be there cheering you on. Again, closing costs, I mentioned it a couple times because some folks just aren't aware that there are additional costs to buying a home. So your closing costs typically are around 3% of the purchase price, right? So let's do the math on that real quick. If you buy I don't know everyone's market, but let's say 350 is the norm. So 3.5%, that's $12,000 in closing costs. And that's separate from your down payment. So that's just something to consider. And yes, sometimes sellers do assist with closing costs, but not always. So it's really important to note. Um, let's talk about the home loan, right? Because we went through the process of purchasing a home, and who within the home loan you've communicated with. But now let's talk about which home loan you select. So this is where we get into the different loans. The first one being conventional, right? And most banks, credit unions, provide traditional or conventional home loans. Your mortgage brokers are a little different. They're just unique in that they specialize in, finding the best home loan for you based on, the loans that they're approved to lend. So you can go to your local bank, right? If you bank with Bank of America, then you can go to Bank of America. If you bank with a credit union, then there are loan officers there as well. And then there's these things called mortgage brokers where they specialize in just home loans. Native community development financial institutions or native CDFIs, they're also very helpful and involved in the home loan process in our communities in Indian country. So just want to be mindful that they're also in this space along with government agencies and government sponsored entities, right? So those folks are in the process as well. So conventional home loans are issued by banking institutions. Sometimes they're called traditional loans. FHA, you're going to hear that a lot. And that is administered by Housing and Urban Development, so HUD. Their FHA home loan product is available for folks throughout the country. And you don't have to have any sort of, it's not specific to Native communities. So the ones that are, those products are called Section 184 and Section 184A. Section 184 is the Indian Home Loan Guarantee Program, and the Section 184A is the Native Hawaiian Home Loan Guarantee Program. So they just want to make that distinction as well. And then there's USDA. USDA is under the Department of Agriculture, and they have a single family both guaranteed program and direct program. We'll talk about both of those in a little bit. And then the VA, right? So if you're a veteran, you have a choice to make. You can choose the VA loan, home loan, or the NADL, the Native American Direct Loan. And so I'll talk about those a little bit and kind of clarify, because some folks get confused as to which one will work best for them. So let's start with conventional. It is not insured or guaranteed by the federal government. That is the biggest caveat with a conventional loan. So typically, it used to be in the past that you had to put 20% down. And so the thought is that most conventional loans are 20% down. That's not true. You can actually get conventional loans that are comparable to FHA or Section 184, where you don't have to put as much down, but you might be subject to PMI, which I'll explain what PMI is in a minute. Don't worry. The debt to income ratio for a conventional loan is 28 to 36%. So conservative, right? Not that high. But there are some programs that'll go higher. But again, these are banks, and banks are businesses, and so they have their different loan products. And so there are some that are in that 41 to 45% range. But what's it going to look like interest rate? It's something to consider. In terms of loan terms, they can also be more flexible in this area. They can do 15, 20, 30-year mortgages as far as the length of the loan. Interest rates, they can be fixed or adjustable. Again, these are banks, and they have their products that they sell. And so they have more range because they're not guaranteed or backed by the federal government. The interest itself is based on the market rate, which fluctuates every day. Every day, the market changes. And it's funny because when the Fed says that they've lowered interest rates, it's actually it's not going to affect the mortgage rate immediately. It's a completely separate rate, and so it does take some time for it to affect us. But just know that, because sometimes folks are looking at the wrong one. Um, the defining characteristics of conventional loans is that it's typically automated, right? They're using algorithms to assess lender risk. That's the big thing. Um, income restrictions, there may be some income restrictions there. Credit requirements. So 620 or higher is these are just the the commonly held beliefs regarding um, the conventional loan. So 620 or higher is typically what we see. Um, because folks had a hard time for a long time getting conventional loans. PMI, I said I would explain it. If a borrower puts less than 20% down, then the lender may require that you have what's called private mortgage insurance. This isn't insurance that protects your home from fire or wind or something like that. This is actually protecting the lender. If you default on the loan, then this helps the lender recoup some of those funds, right? So that's what PMI is, if ever you were wondering. Any questions in the chat? Again, I'm available to answer those as I go or at the end. Um, loan limits. I talked about that already, in the sense that the FHFA, they're the ones who regulate that. So it has to be conforming in most cases. Although they may offer other kinds, most of their home loans, most lenders want to stay with a conforming portfolio. Property types. So this is where, again, you have more flexibility. You can choose single family homes, condos, multifamily homes, even second homes, investment properties. Those are all allowable under conventional home loans. We talked about PMI, so I won't go over that so much. I do want to bring up MIP, because there's some confusion there. So PMI, we talked about that, in that if you default, then this protects the lender. But mortgage insurance premium is a little different, in that it's an upfront premium. So that it's a funding fee. It basically says, hey, look, we want to make sure that you are protected, or we are protected, and so we're going to charge you a fee. Typically, it's 1% of the home loan purchase price amount. So that's something to note. And then MPI, some folks get that confused as well, and I can understand why. Is a type of life insurance, right? That pays off your mortgage if you pass away or become disabled. So that's just a completely different thing. So most often with the ones we're going to talk about next, you're going to see that MPI, because that's the one that you're going to have to pay that 1%. I think with FHA, it's a little higher than that. So your down payment for FHA, 3.5% of the home loan. So let's go back to that $350,000 home I talked about earlier. That means that you're 3.5% of the 350. You'd be paying that $12,250 in down payment, right? So that's a great savings for folks. I actually used the FHA to close on my home here in Georgia, Northwest Georgia. Debt to income was can be up to 43%. Market rate. So the interest rate itself is based on the market, and it fluctuates daily. Credit requirements, 580 or higher. Loan terms, I think they have 15. Most people do 30. Property types, single family home, condominiums. Of course, they have to be FHA approved. Townhouses, manufactured homes. Manufactured homes have to be permanently affixed to the foundation, and you're going to find that most government-backed loans are going to require that. Some multi-unit properties up to 4, meaning you can own a duplex as long as you live in one of the units is your primary residence. You are allowed to live in, as long as that's the case, and you're living in one, and the other is income producing. That's fine. So that's something to note. It's usually an interesting opportunity for folks, especially in Native communities where you have family, extended family. It could be a great opportunity for a family to do something like that. With property specifics, again, backed by the federal government, they want to make sure that the home is safe, sound, and sanitary. It's a term that you'll hear often. It just means that, fixing up a home can be hard to do. There are construction loans, there are FHA construction related homes to assist with that. But in most cases, if you're purchasing a home outright using an FHA loan, then, there, there are some required repairs or things about the home that must be met. So, like, for example, I have seen where FHA appraiser comes out and says, nope, we can't move forward unless that roof is replaced, right? Or we can't come out unless there's railings on the steps because it's not safe, right? So just be mindful of that, that there could be some FHA required, um, items as well. Sometimes they may say, you need to connect to city sewer or water or something along those lines. Again, can the home be safe and sound and sanitary without running water? Not, so some of this is common sense, but again, the lender, and also your agent, if you're in an area that has an agent, that they'll assist you with this. Income restrictions, there are no income limits. So this is great. So if you're a working professional, if you can, you can be an essential worker, someone who maybe makes more than the usual amounts in your area and still be able to qualify. So that's a good one, because I think sometimes our working professionals in Native communities don't have as many options as far as programs go, but FHA doesn't have any income limits. The loan limit itself, how much loan you can get in the area, well, it depends on your geographic location, and so I provided that link. And then, of course, it does require MIP, the mortgage insurance premium I talked about earlier. I want to say, how much is it? 1.75% right now. So that's annual MIP. The other thing to note is that if you put less than 10% down, you'll pay it for the life of the loan. If you put more than 10% down, you have to pay it for the first 11 years. So, as I said, there's other sorts of loans, FHA construction, FHA refinancing. So, if you find a home that's actually, my husband, as a general contractor, is certified to do the FHA 203K, which is essentially saying, I want to purchase the home and I want to fix the home. And so it's a single close, so you only have to close once, but you're able to fix the home along the way. So there are some other unique opportunities out there for folks, but all of that to say, when you speak with the lender and the loan officer, they can provide you with the details as to what to expect with each one of those loans. Section 184, right? That is the one specific to Indian country. The list here, actually, I'm going to pull out this slide here. So hopefully everybody is seeing a map right now. This map explains where in the country Section 184 is eligible. How do you find a lender? You can certainly go to your local bank and see if they are Section 184 approved. There's lenders that we're aware of. The Native Learning Center has used in the past to do trainings and things like that. First Tribal Lending comes to mind, who's worked in Native communities as long as I've been working with them to provide education and training. But it's totally up to you to find lenders in your area that have to be approved by HUD to provide Section 184. So not all lenders are approved. But here you can see partial approved, fully approved, ineligible state, right? So if it's in the red, that means that it has partial approval based on the county, right? So depending on the county in that state, so Texas, right? It's the biggest one. You'd have to scroll down here and look into Texas to see where it qualifies. Whereas if it's yellow, then the full state is approved and you're able to purchase a home anywhere. So for example, let's take Florida. Florida, you're allowed to purchase a home anywhere. Whereas in New York, for example, I hate to break it to you, but you're not going to buy a house in Manhattan, right? So if you go down to New York, there are some exceptions, right? Bronx, Kings, New York, the Manhattan, Queens, Richmond. So there are some areas where you wouldn't be able to get a loan in that area. So hopefully that clears up where you're able to purchase a home. And the requirement here is that you do have to be tribally enrolled in a tribe. I know there are some descendants that attend the courses and things like that. But for down payment assistance, depending on your tribe. But as far as the loan itself, you do have to be an enrolled tribal member to participate. Again, this PDF is located in the presentation, so you can take a look at that and see, where you qualify. Let's get rid of this one. Okay, so the next thing about Section 24 I want to bring up is the loan limits. Depending on where you live, and the county you live in, I should say, then that'll determine the maximum amount of loan that they'll provide in the area, right? So I'm most familiar with Florida, even though I live in Georgia. So let's go to Florida. Actually, how about somebody put in the chat area? Give me a county that you live in and that you're interested to know what the maximum amount would be. Let's do that. So I see Teresa there typing. So you're in Oklahoma, Okmulgee County. Let's practice my alphabet. Go down to O. I'm getting there. Sorry, guys. I know this isn't that fun to look at. O. Okay. And that county started with an O, correct? So more looking. There it is. All right. So the maximum amount of loan that you can get in that area for a single family home, right, is $498,257, right? So now, of course, let's say you found a duplex that you wanted to buy. Well, if that duplex is 637,950 or less, then that would be the maximum amount that you could potentially buy. Of course, you have to qualify, right? So that's the other element to that. But now you can kind of see how this document works and how you can navigate it to find the answers. I'll do one more. Let's see here. We've got let's see. Sandoval, New Mexico. I don't know all the counties, sorry. So if you give me the state, it helps. Let's see. New Mexico, that's not too far away from where I'm at. Sandoval. So also 498,257. So very similar. Again, going back to location and geography, and some places, like I'm familiar with South Florida, for example. So if you're in Orlando, Miami, South Miami specifically, then those prices will be a little higher than places like Brevard County or Port Charlotte or Charlotte County, or some of those other Hillsborough County, the northern or parts of the state, not as many people, more rural. You may not see very high amounts. So it just kind of depends on where you're at. So that's that. Make sure you take hold of that. If you're ever confused, don't know where to find this stuff, the Office of Native American Programs, it's located on their website. All you got to do is go there. We call it Code Talk. You're able to go to that website and pull these documents, and they do get updated. So this one was, the last update was May of 2024. So of course, with inflation, with housing prices rising, they update them pretty often. I'd say at least once or twice a year. I see an update. So let's get rid of this one. Okay. Last thing, I haven't forgotten my Native Hawaiian folks. This is the breakdown for you all. And it's also located on the website. Because it was just May, I think it's like on the main page, so you don't have to go searching for it. All right. So we'll talk about Section 184 here now, in that you can purchase a home, the construction of a new home. So an existing home, you can renovate your existing home. You can purchase. So this is like a single close. You can purchase the home and renovate the home, and then also refinance your home. Right. Of course, you have to be Native American or Alaska Native to participate, which I mentioned before. Tribes sometimes use the program to purchase homes and then sell them to their community, or rent them to their community. So the thing is that they understand trust land, allotted land, and fee simple land. Or fee restricted, I should say, land. So let's say the tribe buys land and they want to be able to build houses on it, just expands the reach, the ability for their folks to gain home ownership. So the main things with Section 184 is that the down payment is 2.25%. So I don't know if you remember, FHA was 3.5%, and so 2.25 is much better on loans over 50,000, and only 1.25 on loans under 50,000. So that's good. DTI is 43%. Interest rates also market rate, but they only allow fixed rate mortgages, right? So there's no adjustable mortgage rate options available for Section 184, because this is a loan that's guaranteed or backed by the federal government. So you do go to lenders to do this loan. It's not like you go to the federal government to do it. It's not direct. So when I say direct, that means you're working directly with a professional who works for the federal government. When I say that it's lender oriented, that means in this particular case, as a guaranteed program, you're going through the lender to get the loan closed. And the underwriting is manual, flexible underwriting. That means that there's an actual person that will communicate with the lender, with the loan officer, excuse me. An actual person is looking at your credit, and sometimes they can make exceptions for things, so it's much more flexible in that way. Credit requirements, it's not credit score driven, so you won't see like a number on there. They are looking at your credit report, so don't get me wrong. You can't have, consecutive late payments, habitual late payments, on all your credit cards and things like that. So they are looking at the credit report. It's not so much that as it is, they want to make sure that they're allowing for Native communities being underserved by banks, not having traditional banking methods and things like that. So they're allowing for that. Manual underwriting exists in this case. I talked about that. Loan terms, 15 or 30 years. Property types. So property types, single family homes, condominiums, they made it easy, and they just basically follow the same guidelines that you see under FHA. Same is true of property specifics, income restrictions. When it comes to loan amounts, I showed you that. And they also have PMI, but it's 0 right now. I don't know how long it'll be there. Right now, the private mortgage insurance is 0. They're not charging that. And the upfront guarantee fee went from 1.5% to 1%. So just know that. And so let's compare them, because a lot of times folks get these two. They're like, I don't know which one I should go with. Well, let's compare it. So on a $300,000 loan, this fee of 2.25%, that's your down payment. 6,750 on a $300,000 loan. With FHA, it would be 10,000, right? So your down payment is much less with Section 184, because they're asking for less in terms of the amount of down payment. So in that way, Section 184 wins out. If you're looking at it from the perspective of the funding fee, right, that 1%, let's look at that. Well, with FHA, it's 1.75, so you're paying $5,066. With the HUD Section 184, you're paying $2,393. So also a better deal. And then, of course, they're not charging PMI, so you're not getting that extra charge per month. So that is a benefit. Next, we're going to talk about Native American Direct Loan and the VA loan. A lot of similarities, but there are differences. So, of course, to use the the NADL, you have to be an enrolled member. The tribe has to have an MOU on a current MOU with the VA office. And so the eligibility, the minimum active duty service requirements, are the same as they would be for VA. Um, there's this thing called the certificate of eligibility where the veteran needs to fill this out and send it back, or they can work with the loan officer if it's a VA loan. So NADL is direct. It's directly working with the Veterans Affairs Office. I'm going to provide you with their contact information, so don't worry about that. But when you're working with the VA can't be everywhere, right? So they decided that for all veterans all over the country, including Native veterans, if you're purchasing a home off reservation, you can use the VA loan. So that's how that works. You just, and so those lenders can actually pull a certificate of eligibility for you. That is just the way that operates. However, if it's NADL, that's a little different. You're going to be working directly with the VA. You have your own staff dedicated, because the NADL is specifically for folks that are purchasing their homes on trust lands, tribal trust lands, or on allotted lands. So that's the difference. To apply for an NADL loan, these are the coordinators. This is the general email. It used to be that they were only open like East Coast time. There were certain offices. Not that it was just East Coast time, but you had certain offices, and if you missed out, then you were unable to connect. And they changed it to where now you have much more of a group of coordinators that can assist anyone. So you're not beholden to one person. Anyone there in the office can answer questions and things like that. So they really streamlined the program to make it more accessible. So hopefully it can be more successful than it has been in the past, because our Native veterans deserve to have this opportunity, especially on tribal trust land. Um, the other thing I wanted to mention about NADL is that they actually have a fixed market rate. So unlike the VA, which is market rate, if meaning whatever the interest is for the day is what you can anticipate, with the NADL, it's 2.5%. That is the fixed rate, and it should stay that way. At least we think it'll stay that way, at least for the next year or two. So that's good news for our Native veterans as well. Again, 0 down payment, so that's a huge savings to the tribal member. Let's see. I want to make sure I'm answering questions. 2.5 until 2025. So we've got, and it doesn't say the month. Yeah, I know it happened last year, or it changed last year. So I don't see, I would hope that they would keep it at 2.5 because that is such a huge saving. May of 2025. Okay, thank you for that, Samuel. I appreciate it. So May of 2025, folks, that's when this opportunity ends, and it'll go back to market rate unless Congress makes that more permanent. So again, down payment is 0, just like the VA loan. Debt to income can be up to 43%, but a fixed rate of 2.5 until May. Credit score requirements, 600 or better. No late payments or delinquencies for 12 months. Note, and this is, no matter the loan, I would just say be careful with overdraft fees. That's another one that folks don't think about as much. But, we're talking about your financial picture. And what does it say if you have several overdrafts in your bank account? Well, maybe you might not be managing the monies well, right? So you don't want to give them any reasons to deny the loan. And sometimes overdraft fees can come up and be a reason. The loan term is 30 years. Limited closing costs. Also a one-time funding fee of 1% of the loan. So just be mindful of that. Property types are similar. And then again, they adopt the similar safe, sound, and sanitary guidelines. Loan amounts. So as of 2020, if you have full entitlement, meaning, depending on the length of service and whether you already have used this particular benefit in the past, you don't have an NADL VA loan limit, right? So you have to check on that specifically with your lender/VA office if you're using NADL. And again, the funding fee is 0%. There is a refinancing option available. So especially those folks that maybe have used NADL in the past, if they have a higher interest rate, then they definitely should look into, or maybe, in your community, this is something you want to promote because they have the opportunity to refinance to a lower interest rate. as long as it's currently like low. I think it has to be lower than what is currently available. Rehab, remodeling loans also. Wanted to point that out. The VA loan pretty much is the same in many ways, except for the market rate, right? So going back to my native veterans who are maybe in urban or even rural areas, but not on reservation, then this is the home loan you'd have to work with. But as far as the defining characteristics, they're pretty much all the same, with the exception of the interest rate. Here you can see the funding fee differences, which is different depending on how many times you've used the loan in the past or the benefit in the past. But that's the VA loan in a nutshell. Any questions about NADL or the VA loan? Real quick, I want to touch on USDA. And I'll also give you contact information for these programs as well. These folks have been very helpful for me as a housing counselor when I'm working with folks. Again, I want to tailor it to fit their needs. And so I bring on the NADL staff is willing to come out and do outreach and training. We've had them come several times when we do our Native veteran homeownership class for Cheyenne River. I've had Section 502 come out to talk to us about the rural guarantee program and also the direct program. And then Section 104, I always get First Tribal Lending to come out. So they're always willing to come out and talk to you about the different programs. And that way you can go into more detail with your clients. A little bit about Section 502. USDA has been very supportive of Native communities. Essentially, this is similar to FHA in that the idea of USDA guarantee is to support rural areas and produce and allow for more home ownership in these areas. So the borrower must, now it does have some income requirements that I want to break down for you. You have to meet the income eligibility. So unlike Section 184, that has no income limits, in this particular case, in most rural communities, they would have to have an income that doesn't exceed the area median income amount. And so in this case, it's 115%. Rural area requirement, the property must be in a rural area. That's a given. But the actual link to the location I wanted to provide. You can go online. You can look up by zip code. You can look it up to see if it's USDA eligible. Similar to VA, right? There is a direct housing loan program. So the guaranteed program, this one here I mentioned earlier, is the kind that is lender friendly. So a lender, as long as they're approved to provide the loan, they can provide it on behalf of the USDA, and the USDA just guarantees the loan. Whereas with the direct loan, you'd be working with the USDA folks to close that loan. And that is to serve the low and very low income households in the area. And the agency possesses and makes the loans directly to the applicant. So makes total sense. The definition of a rural area is that it's open country and not a part of or associated with an urban area. Any town, city, or place that is not a part of associated area with an urban area that is rural in character or a population of 10,000 or less. So that's the formal definition. Of course, you go to the website, you put in the zip code or the address, and it'll let you know if it's eligible. So the down payment, it could be as low as 0%. It's again meant to serve our low and very low community folks, AMI wise. The debt to income here is 41%. Interest rates, I will have to break it down for you. So with the 502 guaranteed, it's a fixed rate and it's based on the current market. But the USDA direct is a little different. So as of August 1st of 2024, the current rate, it'll be 4.875. So just now over 7 days old. So that's a great thing, especially when you consider who this is meant to serve, right? Affordability in these communities must be very hard right now with the cost of the homes themselves. So this is meant to serve and lower those monthly payments. Interest rates, when modified by payment assistance, can be as low as 1%, but again, each loan is unique in that way. And then the payback period is a little different. So most loans are 30 years. In this case, it can be 33 or 38 years to pay back those down payment assistance. So credit requirements 580 or higher. Loan terms, as I said before, 33 or 38 years old. Excuse me, years before maturity. Property types, single family condominiums, same to or similar to FHA in that regard. But again, there are those other characteristics in terms of the definition of rural that you need to be aware of. There are repair loans and grants as well. So I broke that down for you to take a look of if you have someone who might be interested in repairing their home. I've heard good things about that program as well. And so I wanted to include it. Property specifics. You know, it's interesting. They have decent, safe, and sanitary as opposed to safe, sound, and sanitary. And I think too that it's good to note that USDA doesn't have a flip rule. So with FHA, if a home was, let's say, fixed up and sold by a investor, they would have to wait 90 days before they could sell that house. No, so that's a flip rule. Whereas with USDA, they don't have a flip rule. So there are folks out there going to rural areas and starting to fix up homes and things like that. So that's interesting to note. Loan limits, they have 100% financing available, but it just depends. Income restrictions, again, low and very low. This is the community that they serve. They do have a funding fee. That's 1%. And then an annual fee of 0.35%. But they are financing much more than the others as far as the assistance goes. I wanted to note Heritage One. I don't know um, much more than what you see here on the slide. In that, I'm not sure how you can find the list of lenders. I did put a link to learn more because on the Freddie Mac website, they have additional resources. I know the Native Learning Center recently did a podcast with them, but essentially, Freddie Mac announced last year that they have a new affordable housing program called Heritage One. I think it's to assist access to home loans in Native communities, and I think uh, the target audience is actually the Native CDFI, in that they would be the ones providing this home loan product to folks in their community. So, as far as distribution goes and how it would work, I think some of those plans are still in the works, but I just wanted to bring that to your attention because it's just really neat to see us move in that direction. So it's a solution for lending. So I'm assuming it helps build capital or allow for liquidity for the Native CDFI to do more in the communities they're serving. So that's a little bit about them. So I didn't bring it out during that last discussion, but I wanted to make sure you all had it. That's the NADL fact sheet. And I know we're at time, so I just want to say I value your time. And so if you have to leave, the webinar will be recorded. But if you can stay on, I'm just going to really quickly go over a few fact sheets that I also included in the files area. So you're welcome to download it. So that's available for you. Sorry. Hide pod. Okay. But going back to 502 Direct, the fact sheet is right here. You're welcome to take a hold of this and also to find lenders in your area. This is a good place to start. If USDA is something you've been thinking about. I know sometimes I'll do trainings with folks, and everything's great until you start talking about income and you realize you don't have enough income to qualify. It can be very disheartening. And so I think that this is a really good option for folks that are in that space. So again, there's 2 PDFs. One is for Rural Home Loans Direct and one for the Guaranteed program. But hopefully this webinar was meant to kind of highlight the differences between the home loans and also the process of buying a home with a mortgage, and understanding how to navigate that without being totally stressed out about it. The lender that you work with will assist for sure. But it's helpful to get this information on the front end and make our clients more aware. So with that, I'm going to talk a little bit about just having a smooth process on your home loan. For those folks who are going to undertake construction, the guidance that I always like to provide is to make sure that you're pre-approved for the loan amount, and that means that you have already spoken with the builder, gotten your architect and your engineering fees in place. You know what it's going to cost you to build the home, and you have some contingency because prices increases do take place. Change orders can increase your prices, right? If you have to change something midway, that could have an effect. Working with if you're on tribal trust, you want to work with your land management to ensure that you have the TSR, that's the title status report from the BIA. You want to have all your documents regarding land situated ahead of time. Have regular meetings with your builder, your architect, your manufacturer. Make sure that your builder's certified to do the work, qualified, licensed professional, insured, bonded, and approved. That can help avoid additional delays as well. And then lastly, make sure that have your builder contact the lender's approval department so that they can assess whether this is a job for them, right? Because sometimes you have to have so much in assets in order to take on a job. I know there's a lot of local contractors that might be interested in supporting, especially if they're tribally owned, but you do want to make sure that the builder is approved to do the work. Sometimes there's even homeowners that maybe are in the industry and want to build their own home, but there are rules and guidelines regarding that. Avoid impulse purchases. We talked about that as far as going out and purchasing a new car or appliances, things like that. That's a big one for me. Avoid large deposits, transfers from one bank account to another, dollar amounts regarding your overdraft fees, being mindful of that. Payment shock. I wanted to bring up payment shock. For folks of you who aren't aware, when the lender is looking at your income, and they're also looking at your history in terms of how long you've lived in a location, you might have what's called payment shock. Let's say you have been paying $0. You live with your mom, and so you're paying $0 right now in rent. Well, that's fine. However, if you're now being approved for a home that's $2,000 a month, principal, interest, taxes, and insurance, or maybe even just principal and interest and insurance, if it's $2,000 and you're going from 0 to 2,000, that's a big payment shock, right? You've never had to pay that sort of money before, even if you've been qualified for that amount. And so what a lot of the banks are saying, and the programs too, is that we want to see at least 6 months of payments in your account, so that if there's some sort of shock to the system, if you can't handle it, you'd be able to make your mortgage payment. So that's what payment shock is, and that's how they avoid it, by making sure you have that amount in your account. So that could also be a potential issue for your borrowers, in that many folks haven't saved that much. What is that? That's $12,000 that they would need to have in their account to be able to show that they can support the payment if something were to happen. And sometimes it's less than that. They'll do 3 months, 6 months. It depends on the lender, but just wanted to be mindful of payment shock as it is something that folks are thinking about. And then the last thing I think I want to mention is that insurance has risen. um, I don't have the percentage numbers, but it's just risen to the point where it's also making it very hard to afford to purchase a home right now with insurance costs going up. So be careful with that and have folks start to save as much as possible. So this is the list of resources. Again, my apologies for going over, but we have so much to talk about. If you have any questions, I'm always available. Certainly, there's so many qualified professionals in the native CDFI world that can assist with learning more about lending and the different programs that are available in native communities. These are the contacts that I have that they were more than welcome to share their information. So First Tribal Lending is who I typically use when I'm doing my classes. I think he's located in South Dakota. But his coverage area is nationwide. And then I work with Roxanne Woodring, and she is Section 502 direct and also regular guarantee. But she is also located in South Dakota. If and can always point you in the right direction. So that's it for today. I hopefully will be back, I think in September, on another webinar about insurance. And so with that way I can really talk to you about how expensive it's gotten. But I do thank you for your time, and I appreciate you all being here, and I hope you have a wonderful rest of your afternoon.
Thank you so much, Marie. Greatly appreciated. I just went ahead and launched the survey. Here is Marie's contact information. I'm going to go ahead and put her email in the chat box as well, so that way if anybody would like to email her, please feel free to. You can download any of the PDFs that she mentioned throughout the presentation. They are under files. And if you wanted to copy any of the web links, they are under web links. If there's any information that you are having a hard time accessing and would like, please feel free to email me, and I would be more than happy to get you that information that you would like. Here is Marie's email. Okay. So there's Marie's email, and I'll put my email in shortly. Our next webinar is going to be August 8th, a human resources checklist to reduce risk, presented by Lisa Perez. As always, registration is free. It'll be at 2 p.m. Eastern, 1 p.m. Central, 12 p.m. Mountain, 11 a.m. Pacific, and 10 a.m. Alaska time. As Maria mentioned earlier, this webinar is being recorded and will be posted within 24 to 48 hours. You can access that on our website at www.nativelearningcenter.com. You can access this recording and any of our other past recordings on the website from up to 2 years. If you have any questions regarding accessing the recordings, please feel free to email me. You can check up our upcoming events on Facebook, Instagram, LinkedIn, and Twitter. Also, Marie mentioned our podcast. You can listen to Hope a Thing, a Native American podcast on Apple Podcast, Spotify, Google Podcast, and we're also on Spotify. Oh, sorry, Pandora. We're also on Pandora. Thank you everyone for joining us today. We greatly appreciate it, and we hope to see you on the next one. Thank you again, Marie.